Thank you for joining us on another episode of the Dealmaker series. Today, I'm joined by Greg Hext, founder and CEO of Hext Financial Group. Greg, thank you for joining us today. We've spoken before, but I don't think I've had you on my podcast. So, welcome in. Tell us a little bit about yourself and the firm.
Well, thank you so much. We've been around 35 years. Hex Financial Group really has three different pillars underneath and three entities. We have a FINRA SEC broker dealer where we do M&A, sales side, corporate finance. And then we have a full CPA firm with about 20 people there. And then we have a full wealth management group. And we manage about $1 billion over on that side, for various business owners. Our clients are all business owners. We deal with companies a lot that are 25 million in revenue up to in the billions, with a lot of them between 500 million in revenue and 25 million, and across probably 35 or 40 different industries. So we touch a little bit of everything. We deal a lot. We're based in Dallas, but we operate all across the United States. We have private equity firms and family offices and businesses. We operate from basically from California to New York to Miami to Atlanta, Denver, and back to Dallas. And so we cover a lot of space.
Yeah, a lot of range and a lot of a footprint there. So it's excellent. I'm sure
Yeah.
insights would be great from you again. So let's jump right into it. Let's talk about the deal flow. What are you seeing? Are you moving up, down, sideways? Give us a little bit of color on that.
We still see it growing. We probably have twice as many deals as we've had last year at the same time. You're working. It has been lumpy, and it's interesting. The private equity firms are just absolutely banging on our door looking because they've all got a lot of cash and are
Yeah.
looking for a place to invest it. And they're feeling a lot of pressure. And it doesn't seem to matter whether it's distressed or what size, and whether it's lower middle market, wherever it is. The business owners, on the other hand, seem to be a little nervous. And I can understand between tariffs and government shutdowns, it's just been, I'm going to call it one piece of news after another that has caused people to take pause as to what they want to do and how they want to go forward. And is this the right time? Is my valuation going to be low? What's going to happen? And we saw that really starting with Silicon Valley when that crash happened with that bank and the failure a couple of years ago in 23, and it's kind of at times it's picked up and then it's softened back down again. We're thinking that the interest rate reduction should help because it should raise valuations that the firms are paying. So it'll be interesting to see what happens. But I would tell you that over half of the deals that we're working on are corporate finance. And it's because simply that the regular lending sources that business people are used to going to, which was your community or your bank, your local banker, that avenue doesn't exist for a lot of people anymore. That box has gotten so small and so tight, and it's the regulators that are causing that problem. And that again started with Silicon Valley and has continued forward. So private credit has become the go-to place. And so there are all these non-traditional lenders that we deal with. In fact, last year, numbers came out recently. Last year, 78% of the corporate finance transactions that were done by private credit rather than your typical commercial lender. So banks have become depository institutions, not lending institutions anymore. So probably half of what we see is people saying, hey, I want to buy this company, or I want to finance this equipment, or I need growth capital. We've got all of those kinds of transactions that we're working on and getting them done, but you would not get them done through their traditional lending process and stuff. And it's just because lenders are so tight.
Yep, yep. I've been getting a lot of that this year as well. I've noticed a slight uptick in, or at least like the folks I'm talking to, they're telling me that they're noticing a slight uptick here in Q3, Q4. Right now, we're, I guess, right in the middle of Q4. This is November, and I'm thinking that it's probably a combination of things where, you know, deals that should have been done in Q1 got pushed a little bit later. So now they're taking place, as well as, we're kind of at the end of the year. People are trying to tie off deals. And we've also gotten that signal from the Fed that interest rates are coming down. We've already now had two cuts. So I think it's a combination of that. So what about structure? Are you seeing anything new in the structure of deals here in Q4, Q3?
The one thing we are seeing is there's a lot more minority private equity group and investments. I would say the private equity groups. 5 years ago, if you did told a PE group you wanted to do that, they'd laughed you out of their conference room. But now that's become a much more typical deal. And again, I think it's because they're willing to figure out how to structure something, and they would like a stair step buyout, but they're willing to do that. We have one that actually the LOI was signed, I believe, yesterday. We'll have the first diligence call tomorrow, and it's a sell side um, entity from down in Laredo area that does customs brokerage across the border on both sides. And the buyer truly wants to close by year end. We'll see how practical that is. I mean, as you and I both know, the legal docs alone can take 6 weeks, and we haven't even seen the first draft of the stock purchase agreement yet. But he's going to roll 33% of his purchase price into the new deal, and this company has got backed by a very large $1 billion fund. They've already done some acquisitions. They're going to add him on. They're in logistics, customs brokerage, that kind of thing, but not on the Texas border. And so he's going to be another bolt on for them, and they're going to continue to grow. And we're continuing to see stuff like that. We truly had one of his other buyers. He had 5 that he really liked that he had sourced over the last couple of years. And one of those he called and told them that you were $9 million off on the purchase price. And they said, well, we'll match or exceed the other person, when he told them no. And he said, well, I've already committed to these other people. But my comment to him was, I said, I would just hold on to them as my backup, my plan B. It never hurts to have a backup and see what happens. But they were not his first choice, but it just shows you how quickly people will pivot if
Yep.
they feel like that, the market is telling them something different. And so we are seeing some movement like that.
Yeah, that definitely aligns with what I've been picking up here in the second half of the year with the higher equity rollovers taking place. That's a trend now. Cash being king. I've heard that several times where
Mhm.
just having the cash will put you over the top. Where like you got that situation where these guys say it was more, like, all right, well, we'll match you right now. Done. Very interesting stuff right there. What about industry or sector? Are you seeing any kind of trends around active sectors?
It seems that everything is pretty active. I mean, we're not, the one thing we're seeing that's been kind of a little bit of a pushback is oilfield services, with, kind of some of the issues going on in the oil field and Exxon buying Pioneer. And, some of those things have created some, I'm going to call it disruptive movement in the market. But, we're still seeing there's family offices, for instance, in Houston that are focused on oilfield services right now, and so there's a market out there for that. But it's interesting to watch, but that's the only place that we've seen that. Even in commercial real estate, we don't do a lot of just standalone commercial real estate, but even there we're seeing activity and people doing things, and even getting some I'm gonna call it some borrowing and stuff done, and some lending type transactions done. But we're not seeing anybody really redlining area. I did talk to a group the other day, and they were talking about retail was still something that gave them some heartburn, that they weren't really
Mhm.
interested in. And I
Yeah.
went, yep, okay, I get that. And but it just depends on the fund. But we're seeing then, I'm gonna call it, we have a deal sheet, a deal summary that we kind of put out every month that says, okay, here are all the things we're working on. And we're hearing what other people are saying they're looking at. And it's a little bit of everything. I mean, you're still seeing all the people that want to do stuff in HVAC and plumbing and that kind of thing, and buying up smaller entities and stuff. But we've got clients in aerospace, you know, a lot of other different areas and stuff, logistics, just pure trucking, transportation, manufacturing, distribution. Some of the oil field spaces like spooling and things like that seems to be a lot of activity there. Recycling, different things like that. Lots of different things that are out there that
Mhm.
are in the market. But we're seeing a little bit of everything from services to, optometry practices to just with people coming to us looking for different things and giving us their list.
Yeah. That kinda echoes that sentiment you mentioned earlier about there's a lot of cash that needs to get invested. I think that's probably a reflection of that right there. It's kinda like, just deploy the money. At this point,
Yeah,
folks are, their vintage year funds are at 5, 6, 7, 8 years, and, they need capital return, but they also need it redeployed, and I think,
right.
yeah, if I'm in that boat, I'm just like, "Hey, you know what? Just deploy the money wherever. Don't lose it." You know? Like, do your due diligence, but we need to get this money moving. You mentioned tariffs and the interest rates earlier, and I know we could probably have an entire episode around that, but can you shed any light around how the tariff situation or interest rates are impacting deals right now?
Interest rates are helping just because, like I said earlier, it increases the amount of leverage and the valuation that PE firms can put on a deal. We are seeing it helps, of course, with somebody in terms of just when they're trying to measure up on a cash flow deal and get a lender to step up. That's helpful. Most of it comes from valuations on the interest rate side. It's interesting. We have like our customs brokerage guys down on the border because of what's going on with people. I'm gonna call it onshoring and moving back to Mexico and doing this kind of stuff. They're seeing a huge uptick in terms of their business. So, they were already growing at 10% plus each year, and they're probably seeing more than that this year. And they're saying, they actually went out and they have a 200,000 square foot warehouse that they rented to expand to be able to handle some of the volume. And, they're using 100,000 square feet of that. To give you an idea, too, the number of rigs Laredo, as an example, is the largest inland port in the United States now. And on a typical day, there's anywhere between 16 and 40,000 rigs crossing the border in Laredo. And I mean, the number is staggering in terms of the
Yep.
amount of inbound and outbound cargo that's moving across the border. And it's all because things are being made. One of our clients that's in the transportation business down there moves Legos, for instance, as an example, from Monterey and some other locations to Dallas. They move 50 rigs a month to Dallas distribution for Legos. That's just one customer, and they have 150 of them. And
Wow.
but they move Legos, and they were talking about how much of that kind of stuff is happening, and whether it's it's not just auto parts. I mean, the thing that the broker was telling us was a big part of there's just medical devices that are being made for people like Siemens and all these folks that have plants down there that are making parts for different product and stuff that they're doing. We also have a client down there that white labels. They laugh that they're in the legal drug business. They white label products for Walmart and Walgreens, and they put it and they package it, send it up here, and then they box it here into their appropriate boxes and put it on the shelves. And so, but it's all made down there. It's not something you would typically think of being made in Mexico, but it is.
Yep. You've kind of alluded to this here and there. My next question was, what about the DFW market or Texas? What are you seeing there? You got a big footprint, as we talked about. So what is kind of setting DFW or Texas apart, do you think?
It's just going to continue to explode. I mean, I think Dallas will be the number 2 finance market in the United States. It's probably close to that now. I know that,
Yeah.
like with JP Morgan, we have more JP Morgan employees here than they do in New York. Jamie's got a problem in that $3 billion new headquarters he built, especially with their change in the political
Yeah.
environment. I'll be nice to say that in New York, there's going to be a lot of people looking for a new home, and
Yeah.
so it'll be interesting to see what happens. But I think like Goldman Sachs for the new 5,000 person office. I mean, it just keeps on coming. The new stock exchange that's going to be here. And we're a business friendly state. I mean, we do calls with clients every day, advising them on how to deal with taxes and structuring and all that for their companies in Texas, or you want to be in these certain states because of like us with a franchise tax. There's not a personal income tax. There's not a corporate tax. So it's very business friendly. I was looking at some of the, I'm going to call it places that 30 minutes from Dallas, you can still buy a home over like in Greenville, Texas for $250,000. It's a 5-bedroom home, and that you can't get that in Frisco and Salina. It's probably a $500,000 or more, but it's interesting to watch what's happening. But even that, I was with some people from California this weekend, and they were telling me they were just absolutely fed up. And the guy owns a lot of multifamily. He told me, he was actually, we were in Greenville at an event, and he said, I almost wanted to throw up when I saw the price of gasoline here. He said, $2.49. He said, do you know what I paid per gallon to fill up in California before I left on Thursday? And I said, no. He said, $5.10 a gallon for
Yeah.
gasoline. He said, it's a
Yeah.
hundred and some odd dollars to put a tank of fuel in your car. He said,
Yeah.
we spent $3 billion trying to solve a homeless problem. And he said, I can tell you it's worse than what it was. And so I think there's a lot of people that are looking at what's going on in Texas and going,
Yeah.
hey, it may not be perfect and it never will be, but it's more business friendly and housing is fairly decent. There is a shortage still of people to work here, and and I think it's getting a little bit better, but it is interesting. But I think Dallas has got so many perfect things going for it until I think we will end up being that really large finance market in the United
Yeah,
States.
I agree. I agree very much. I think we're about to see a surge in our attraction to venture capital as well. I mean, particularly with the stock exchanges moving here, especially the Texas Stock Exchange and their strategy, but also just how we're growing quickly in fintech, we're growing quickly in biotech as well, and looking to challenge Boston and the Bay Area and all that. I think there'll be a surge there as well. Okay, so last question, and let's take out the crystal ball.
Okay.
What major shift or shifts do you see coming, let's say in the next year here in the M&A space?
I think it's going to continue to pick up in 26. Now if somebody goes and drops a really big bad bomb somewhere, all bets could be off. But that could happen today. Could never happen. Okay, but I do think that we're continuing to see an aging population of people that are late 70s, even 80, that own operating companies. I visited with a guy recently that he and his wife were both in the hospital. I mean, and they're talking about selling their company. We're still
Yeah,
getting phone calls from people that that mom or dad have passed away. The so I really believe that there's still a huge backlog of M&A work to be done. That and I was absolutely dead wrong on this. I thought 10, 15 years ago, when people were supposed to be retiring, we would see 60 to 65 and people would be selling off their companies. Well, that didn't work. They're
no,
all now 75 and they're still running them, and some of them still probably will to the day they die. And I always laugh and tell people, I mean, we have a nice succession plan for Hex Financial Group, but I laugh and tell people that I want to be like Ross Perot, that I want to be in the office up to about a week or two before I'm gone, and continue to do my thing and take care of my people, and work through it. But I think there's a lot of that still out there. And I think
yeah,
there's a lot of next generation that aren't interested in running the companies their parents own. And
yeah,
I was laughing, telling somebody, I said, understand the word work is a 4-letter word, okay, in today's society. And I was talking to these guys, they were just dying laughing this weekend.
yeah,
But people from California and all these other places are talking about moving here. And so,
yeah.
what do you say?
Man, it's funny. I agree with every bit of that. And I said pretty much the same thing not even a couple weeks ago after my last event on the state of deal making. And I kind of gave my insights from folks like yourself who I've interviewed this year, and pretty much almost word for word. I was like, 2026 is going to be, there's going to be a lot of work provided no bombs go off, no, getting blindsided by anything like we did this year. And I think there's a lot of really, really, really pent up demand. And then your points on, folks working longer, not selling their businesses, or if they do, they're selling it for health and they have to. And then like the kids not wanting it. That's the consensus
Well,
right now. Everyone's,
valuations are going to go up. I'm convinced
yeah,
valuations are going up. The private equity firms, when you hear and look at the numbers, there's something like $25 trillion sitting in cash. I mean,
yep,
so there's like, again, there's this huge demand on the buy side, which tells you that if prices go high enough, people will eventually sell. You and I both
yep,
know it's all
yep,
driven. And exactly our client with the LOI he signed, he had a number in mind and he wasn't selling. He started his company with his wife at $2,000, 25 years ago, and they're doing 30 to $40 million in revenue this year. And he just wasn't going to sell till he got to the number that he wanted to get to. And I think, be it irrational or whatever, it's irrelevant. If they own it, they don't want to sell it, they're not going to turn loose. They'll continue to do it.
yeah, yeah, I agree wholeheartedly. Greg Hex, I appreciate all these insights, man. There's a lot of great information. Those watching, I think you'll find all of this very useful as well. You can check out some of the other episodes of the Dealmaker series on my YouTube channel and follow me on LinkedIn. Greg, thank you
You're
again, sir.
welcome. Thanks for having me. Have a good day.